Goldman talked about a 31-ton dump, but they didn't make any delineation between the Shanghai Gold Exchange and the Shanghai Futures Exchange. So I did a little digging. The Shanghai Gold Exchange delivers less than 4 tons a day, right? And so, in essence, the majority, if not all, of this dumping was done in the futures market. And so I think that that's important here. You're not seeing physical gold being sold off. You're seeing futures being sold.
Gold prices dropped sharply on Thursday, hitting their lowest level in 2 weeks. And according to one market expert, it all started in China. Adam Gillard, a trader at Goldman Sachs who closely tracks precious metals, believes the sell-off was driven by a wave of profit-taking ahead of China's Labor Day holiday. He says nearly 1 million ounces of gold were dumped through the Shanghai Gold Exchange and the Shanghai Futures Exchange, a move that reversed most of last week's gains and cut China's onshore gold holdings by around 5% from record highs. Gillard notes that while China still accounts for about 40% of global open interest in gold, this latest pullback suggests the recent rally may have hit a temporary ceiling. As a result, spot gold fell to around $3,200 an ounce, a level not seen since mid-April. According to Gillard, the market has become increasingly sensitive to shifts in China, with most price swings now occurring during Chinese trading hours. Just last week, Chinese investors had added roughly 1.2 million ounces as gold surged past $3,500 to reach an all-time high. In his view, this shows how much influence Chinese sentiment and liquidity now have on global gold prices. He also describes gold as a flow commodity, meaning it tends to react quickly to big changes in investor behavior. While Gillard attributes Thursday's gold sell-off to investor activity in China, renowned bullion dealer Andy Schectman offers a very different perspective. In a recent interview with Liberty and Finance, Andy argues that the real force behind the sudden price drop isn't retail traders, it's the bullion banks. According to him, institutions like Goldman Sachs have long been involved in suppressing gold and precious metals prices through strategic short selling, derivatives manipulation, and other behind-the-scenes market tactics. Andy suggests that what we saw on Thursday is yet another example of this ongoing market interference, a coordinated effort to shake out weak hands and maintain control over the price narrative. We'll now show you key clips from that interview, where Andy lays out his case in detail. If you're finding this coverage valuable, don't forget to like this video, share it with others who follow the gold market, and subscribe for more expert insights. And be sure to hit the notification bell so you never miss an update.
The most basic, simple way of describing is that central banks aren't going to go back to buying treasuries and selling gold. I think that from here on out, you're going to see more turbulence, more volatility, sharper swings, but nothing's really changed. In fact, I just think you have to not get shaken out. The bull wants to take as few people along for the ride as possible, and you have to keep your perspective. They try and tell us that this was the Chinese dumping like 1 million ounces of gold. Let's just put that in perspective. So first of all, when we talk about Chinese gold-backed ETFs, in the month of April, they saw more inflows than all of 2024, and that's just in the first 11 days of the month. When we talk about China dumping gold, first of all, their markets are closed right now until May 5th, which is very peculiar. In fact, this lends itself to making you think of conspiracy and of manipulation and of suppression during Chinese trading hours when their markets are closed. That's a clever trick. To me, that's very suspicious, to say the least. And Goldman Sachs' story is very suspicious. And I think the bullion banks were able to exploit the closures in the Chinese markets to smash the price. If you look at a chart, a continuous 24-hour chart, you see it go up every time it hits Chinese trading. It goes up and gets smashed as it comes into New York. Well, with all of the Chinese markets being closed until May 5th, suspicious. Goldman talked about a 31-ton dump, but they didn't make any delineation between the Shanghai Gold Exchange and the Shanghai Futures Exchange. So I did a little digging. The Shanghai Gold Exchange delivers less than 4 tons a day. In essence, the majority, if not all, of this dumping was done in the futures market. And so I think that that's important here. You're not seeing physical gold being sold off. You're seeing futures being sold. It's done for effect, for sure. Let's talk about what's happening here in the United States. We saw for the May contract in gold, 9,306 contracts stand for delivery. That's the second highest ever for a non-active delivery month. The silver May contract, 14,813 contracts stood for delivery. That's the second highest ever, just behind March's record delivery. And we're beginning to see these short positions that are closing their positions, and you knock it down, and yeah, a good way to close it. But it seems everything's settling for physical delivery. The other side of the short, the long, says, great, we'll stand for delivery, please. Who are those longs? We don't really know. But to me, this just exemplifies continued demand at the highest level. So I think people need to put things into perspective. It's been quite a run in gold. Silver hasn't begun to blow out from its technical formation. I suspect it will, and probably much more so than what we witnessed in gold. But yeah, I would just simply say that it's going to be bumpy, but nothing has changed, not even a little bit. And with the Fed meetings and all the things that are happening, I think perception, this was a perfect opportunity for, if I had to guess, the Western bullion banks to knock the hell out of the price, say it's the Chinese, even though their markets are closed, do what they can to close out their short positions, or to, settle things with metal that they're able to then physically buy on the cheap. So this doesn't bother me at all. It, nothing goes straight up. It's certainly violent, but also put it in perspective, a $60 or $70 drop is 2%. So it's not a massive drop. The dollar numbers are higher than most us gold bugs really think about, because it hasn't been at these levels for very long. And when you're at 3,000 plus gold, a $300 move, well, it's still 10%, but it's a big one. But when you see $60 or $90 move, which really freaks people out, you're talking under 3%. So, yeah, you're going to see paper market volatility. That's just the bottom line. You're going to see that the higher the price goes. But I still think gold and silver will climb the wall of worry that everyone is freaking out about on social media right now.
It's completely understandable that gold and silver investors are on edge after the recent dip. But here's the bigger picture. Price pullbacks are not only normal during bull markets, they're often necessary. In any strong upward trend, the market needs moments to breathe. These temporary corrections help shake out speculative positions, rebalance supply and demand, and create a healthier foundation for the next leg up. In fact, bull markets rarely move in a straight line. They typically advance in waves, with periods of consolidation or pullback in between. These dips can be driven by a range of short-term triggers: profit-taking, margin calls, changes in sentiment, or large institutional moves, like we just saw with the Chinese sell-off, or what some believe to be market manipulation by bullion banks. Moreover, the precious metals market is particularly sensitive to macroeconomic shifts, like interest rate changes, dollar strength, and geopolitical developments, all of which can cause sharp, sudden moves in price. But fundamentally, if the long-term drivers of the bull market remain intact, like high debt levels, inflationary pressures, central bank buying, or declining confidence in fiat currencies, then these dips should be viewed as buying opportunities rather than red flags. In short, temporary price weakness doesn't necessarily mean the end of the bull run. In many cases, it's just the market preparing for the next big move. During the discussion, Andy argues that as long as these factors remain unresolved, gold and silver prices will continue to rise.
All of these things to me are peripheral noise. No, it's not. That doesn't change the structural problems that we have with the monetary system, with our indebtedness, with everything. But and we should hope for peace, certainly. But no, I don't think that changes anything at all. In fact, you could argue that when the war is over, you may see a larger, more concerted effort by the BRICS nations to focus on unity, to focus on trade. We talked about last week. 40 plus countries have applied for the BRICS, Vietnam being the last, and their new payment system, which is now open to non-member nations. They haven't slowed down behind the scenes. They're just not as open about it anymore. And the Russian finance minister is all over the place, Lavrov, talking about this. And so peace is good, but it should not have anything really material to do, in my mind, with the price of gold. Really, it shouldn't. I don't, even if it ended today, I don't see how it materially impacts the United States, the dollar, or any of the problems that are fiscally or monetarily in front of us.
Any comments from you on the concept that some retracement to Fibonacci levels is normal and healthy in a bull market?
100%. Richard Russell, I'll make it easy because the Fibonacci numbers, I don't know off the top of my head, but yes, that is true. Richard Russell always used to say at least a 50% retracement. When you see things move up that high, a 50% retracement is normal. And it is normal and healthy, with somewhat of a gold squeeze. It moved a little too fast. It was exciting. And, we were all thrilled by it and expected it to go straight up forever, but it won't be that easy, not even a little bit. But take a step back again, and you got Treasury Secretary Bessent saying that the bond markets are signaling it's time for the Fed to cut rates. Well, they want to go back to, more easy money and perhaps even quantitative easing. Again, this is very gold friendly. Powell didn't say flat out that he's going to abandon his dual mandate, but he hinted at it. In other words, they're caught, and they know it. We're caught between the ability to fight inflation and to keep rates low enough to stimulate the economy. You're seeing mass layoffs. You're seeing a slowdown in the economy. And so I think, what do you do? I think Trump wants lower rates. He wants a lower dollar, as we've seen. And now you have the Treasury talking about coming in and buying their debt as well, finding ways to buy older maturity debt. Again, this is all monetization. We saw the negative print on the GDP, right? And so the 2-year Treasury yield is 3.56 right now, but the federal funds overnight rate is 4.33. This is more of what we saw before. This is classic yield curve inversion. This screams of a recession coming, with inflation fears elevated already. May 7th is the next Fed meeting. A lot of this is done by design for optics, with the Fed meetings coming up, and everything is okay, don't worry. But they want to lower rates. They want to lower rates not only on the front end of the curve, but even the 10-year, and stimulate. You're going to see a reignition of inflation. This is all very gold friendly. So, I think there are some big players that are caught in the futures market that would love nothing more than to extricate themselves from these positions. Seeing the metals market get knocked down like that and see all of these contracts closing out is not surprising to me. What is surprising is people's reaction, thinking that, well, maybe we should go from risk off to risk on. Absolutely not. I think that this is why, emotions very often get the best of us, and it's natural. I get it. It is emotional. But you got to take a step back and ask yourself, what, if anything, has changed? We're not saving any money on our indebtedness. In fact, we're going deeper and deeper into debt, even with Doge. So the indebtedness is still a problem. The fragility of the economy is still a problem. The geopolitical issues are still a problem. Nothing's changed. But what has changed is there's greater volatility in the market.
As we've explored, the recent drop in gold prices has sparked quite a bit of speculation, with market experts offering contrasting views on the underlying causes. On one hand, we have Adam Gillard's analysis, highlighting the role of China's market behavior and profit-taking ahead of the Labor Day holiday. This suggests that gold is highly sensitive to shifts in investor sentiment, especially in major markets like China, where fluctuations can trigger significant price swings. On the other hand, we also have Andy Schectman's perspective, pointing the finger at institutional players, specifically bullion banks, suggesting that their behind-the-scenes tactics, such as strategic short selling and market manipulation, may be playing a bigger role than most retail investors realize. This difference in opinion only underscores how multifaceted the gold market truly is and how important it is to stay informed about both macroeconomic trends and the actions of large institutions. But here's the crucial takeaway. Pullbacks like the one we've seen are common in bull markets, even necessary for the long-term health of the market. They provide an opportunity for the market to breathe, rebalancing positions and paving the way for the next phase of growth. So while this dip may feel uncomfortable in the short term, history suggests that these corrections often precede the next major upward move, especially when the long-term drivers of gold's bull market, like inflationary pressures, rising debt levels, and global uncertainty, remain firmly in place. In short, don't let these temporary dips cloud your view of the bigger picture. Whether you're a seasoned investor or just starting to explore the world of precious metals, understanding the broader trends and the various factors at play will help you make more informed decisions going forward. If today's video has given you valuable insights into the gold market and its complexities, make sure to like this video so others can benefit from the discussion as well. Share it with anyone you know who's following the gold market or interested in understanding the deeper dynamics at play. And, of course, subscribe to the channel for more expert commentary and analysis that dives into the trends shaping the financial world today. If you don't want to miss out on future updates, make sure to hit the notification bell, because in a fast-moving market, staying updated is key. I'll continue to keep you informed, whether it's about the latest gold price moves, interviews with market experts, or deep dives into what's really driving the financial world. Thanks for watching.